Welcome, everyone. On behalf of the Southern Alliance for Clean Energy, I'd like to thank you for joining us for today's webinar titled OnBill Financing 101. My name is Erin Cameron, and I'm the Development and Outreach Coordinator for Southern Alliance for Clean Energy, and I'll be the moderator for today's webinar. Just a few housekeeping items before we get started today. To ensure sound quality, all of the attendee lines have been muted and they'll remain so throughout the presentation, but we encourage you to please type in any questions you may have in the questions box. It should look just like this on your control panel, and we will answer the questions at the very end of the presentation today. For those of you not familiar with Southern Alliance for Clean Energy, we are a regional organization focused on promoting responsible energy choices that create global warming solutions and ensure clean, safe, and healthy communities throughout the Southeast. We are a membership organization, and I'd like to thank all of our members on this call and encourage those of you who are not members to please join us today. We are in the middle of our fall member campaign, and you can become a member by simply going to the donate page of our website, cleanenergy.org. Our members help to make our work and programs like this possible, so thank you very much. Our presenters today will be Rory McIlmoil from Appalachian Voices and Taylor Allred from Southern Alliance for Clean Energy. Rory is the Energy Policy Director for Appalachian Voices, a local environmental nonprofit organization working to protect communities across Appalachia from the negative impacts of natural resource extraction and to advance their vision for a clean energy and economic future for the region. Prior to joining Appalachian Voices in early 2013, Rory served as a campaign coordinator for Coal River Mountain Watch, a community-based nonprofit in southern West Virginia, and as the Energy Programs Manager at Downstream Strategies, West Virginia-based environmental consulting company. Rory holds a BS in Earth and Environmental Science from Furman University and an MA in Global Environmental Politics from American University. He has 7 years of experience working in the fields of energy policy and finance, environmental protection, and local economic development. Today, Rory will be providing a more in-depth discussion of on-bill programs provided by rural electric cooperatives in the Southeast, as well as ongoing efforts and progress toward developing an on-bill program in Tennessee. Taylor Allred is the Energy Policy Manager for SACE and joined us in June of this year. His role is to advocate for the implementation and ongoing growth of energy efficiency programs in the Southeast, with a focus on Tennessee and the Tennessee Valley Authority. He participates in regulatory proceedings and promotes effective strategies for utilities to help customers to minimize waste and thereby reduce future energy demand and the need for new generation resources. Prior to joining SACE, Taylor worked as an energy research analyst at SNL Financial and as a financial analyst at Regulatory Research Associates, where he was in charge of analyzing and reporting on utility regulation in the Mid-Atlantic. Taylor holds a BA in history from the University of Virginia. Taylor will be covering a more general overview of on-bill financing and program design options, and he will be getting us started today. So I'm going to go ahead, Taylor, and switch the controls over to you and let you get started.
Thanks, Erin. This is Taylor. I'm hoping everyone can hear me all right.
Yep, you sound good and everything looks fine.
All right, great. Thank you. So I just want to get started by first defining what on-bill financing is. And here's a definition from the American Council for an Energy Efficient Economy, or ACEEE. On-bill financing generally refers to a financial product that is serviced by or in partnership with a utility for energy efficiency improvements in a building and repaid by the building owner on his or her monthly bill. So why is on-bill financing a good idea? While energy efficiency is highly cost-effective for reducing energy waste, there can be a problem with upfront costs, and that can affect small businesses, residential customers, including renters, and really anyone that's capital constrained. On-bill financing overcomes that barrier by providing the financing upfront, which can then be repaid on the monthly bill. There are examples of programs in the Southeast at municipal, cooperative, and investor-owned utilities. So there are a lot of different options for how to design an on-bill financing program. And these are the high-level issues to think about as any utility's thinking about going down this path. I'll go into each one in more detail, but just generally, first, there is a traditional approach of a loan that's issued out and then repaid on the bill. And then there's also a separate approach that's debt-free and uses financing in a tariff that characterizes it as a utility service rather than a loan. Bill neutrality refers to a requirement that the estimated monthly bill savings should meet or exceed the monthly loan payments. There are many different sources of capital that could feed into these loans or the financing through tariffs, and the program could be designed to apply to one or several different customer classes. The utilities may want to consider what measures are eligible for financing, and then also what level of rigor will go into upfront energy audits and post-installation verification of savings. There's also the option of requiring disconnection of utility service for non-payment of the financing instrument. And then there are also a lot of options for underwriting criteria to approve people for financing. So first I'll get into a little bit more detail about the tariff-based approach, which is a promising program designed to open up financing to a lot of people that might not be able to access a loan that's simply repaid on the bill. So it is debt-free, so it won't show up on the customer's credit report, and it would be transferred more or less automatically to the next customer at that meter. Disclosure would typically be required, and it can open up the program to renters in addition to homeowners, since a renter typically wouldn't feel comfortable with taking out a 5 or 10-year loan on a 12-month lease. In order to participate, the renter would typically need to get landlord consent, and if there is an extended vacancy, the landlord would typically be on the hook for making the minimum loan payments. There's generally a grace period before that kicks in. The tariff-based approach does reduce default risk. Part of that has to do with disconnection for non-payment. The assumption is that the customer would move out if the lights are turned off. It can also open up the possibility that the financing instrument would be able to survive foreclosure or bankruptcy. And in order to implement a program with the tariff-based approach, there may need to be enabling legislation or at least approval from the Public Service Commission. One other benefit, similar to the way that for a resident, tariff-based on-bill financing wouldn't show up on their credit report, commercial customers may also be able to treat it as an off-balance sheet item. Bill neutrality, as I alluded before, generally just means that the estimated monthly savings are required to equal or exceed the monthly financing payments. There are several benefits. It would protect consumers against the risk of having an increase in their bill and reduce the risk that they won't be able to pay that bill. It rations limited program funding to make sure that they're going to the most cost-effective improvements, and it can help to drive consumer adoption since customers may be more interested in immediate savings. There are a few drawbacks as well. It can conflict with state energy policy goals for utilities to capture all cost-effective energy savings, since some cost-effective measures may not yield immediate bill reductions due to the upfront cost. By restricting eligible measures, it can potentially drop customer interest somewhat. And also, certain measures may only be bill neutral in a longer repayment term. Another thing to be aware of is that inaccurate estimates of what the bill savings would be immediately could be problematic. If customers are counting on their bill going down to be able to pay it, then they could be very dissatisfied with the service. There are quite a few sources of capital for investor-owned utilities. It could come from either entirely ratepayer charges through their energy efficiency portfolio. It could be implemented with shareholder capital with a return on investment allowed. And there are a few considerations to think about with each of those approaches. For investor-owned utilities or municipals and cooperatives, they could look at private lenders. They may need to consider interest rate buy-downs or loan guarantees to be able to get the approval rate high enough and the interest rate low enough to open it up to a lot of customers. One option that they can also consider is the warehouse model, where the utility would essentially bundle the loans into a debt instrument that they would sell to a third party. Another exciting new source of funding for cooperatives and smaller municipal utilities comes from a number of programs offered by USDA. Rory is going to get into more detail on that. And finally, there are also grants available in different states that the utilities may want to look into, especially for initial program design and administration costs. So another consideration is what customer classes will be included. For residential, you want to consider whether or not renters will be eligible or just homeowners. And then when looking at the rental market, you want to also consider that there's a separate option for taking a multifamily approach where the landlords rather than the tenants would get incentives and finance upgrades to the entire building all at once. There are a number of benefits the landlords could yield from that. And outside of residential, there are also a number of programs that target commercial customers and to some extent industrial. Commercial customers or commercial programs tend to be somewhat less common, but they can actually achieve much higher market penetration where the programs do exist. For industrial, the customers often have unique energy uses. They may have very specialized equipment that require the utility to send out an energy advisor to figure out the best uses for funding to reduce energy consumption. Another consideration is what measures are eligible for financing. Some programs do allow the inclusion of non-efficiency measures. That can include distributed generation, putting solar panels on the roof. It can include demand response equipment that can be used to shave peak load. And some programs actually include non-energy measures. So the common example is, well, after making efficiency upgrades, there's some money left over and the customer may want to say, put in granite countertops. There's some problems that come out of including non-efficiency measures, particularly non-energy measures. Specifically, it is very difficult to make the loans bill neutral if they're spending it on items that aren't going to reduce their utility bill. Within efficiency measures, the utility looking to design a program should consider whether they want to allow single measures, so like just installing a heat pump, versus comprehensive retrofits that would try and target every available opportunity for cost-effectively reducing energy usage. The single measure programs tend to achieve higher loan volumes, but some of the savings may be capturing existing market activity where the customers might have gone out and gotten financing elsewhere and made those improvements anyway. The retrofits do drive greater savings for each loan, but the trade-off is that it may be harder to achieve high market penetration. Finally, you want to consider the utility bill impacts, and I talked a little bit about bill neutrality. So for audits and verification, it's pretty important to start off with an energy audit, especially for comprehensive retrofits, to identify the best uses of the financing for reducing energy consumption. And then after installation of upgrades, there's generally some level of verification to make sure that those savings are realized. There are a lot of options for how detailed and thorough these processes may be. And while it's great to have very thorough, rigorous auditing and verification, there's a trade-off with the cost effectiveness of the program, and it can really be where the rubber meets the road for whether the program is successful and able to be sustained. One potential solution is to require audits up front and then afterward have a year of billing analysis or more for each project, and then just for a sample of projects have very thorough verification of savings with blower door tests, and use that to extrapolate and come up with a figure for what the entire program is achieving in terms of savings. In all cases, for any major equipment installation like a heat pump, it's good to make sure that it was installed correctly at the very least. Utilities do have the option of requiring disconnection for non-payment. It's typically required as part of a tariff-based approach, and the disconnection provision may require enabling legislation. It can lessen lenders' concerns about defaults and thereby improve approval rates for applicants. But based on limited data and an analysis by C Action, a DOE initiative, which I will reference later on, it's not clear if there's truly a correlation between default rates and disconnection provisions. There are a number of different options for underwriting criteria, which is how you figure out who you're going to approve for on-bill financing. Traditional underwriting is like a typical loan where you have a minimum credit score and potentially also a maximum debt-to-income ratio. Expanded underwriting is similar to traditional underwriting, but it just relaxes some of the standards to increase the number of customers that will be approved. Alternative underwriting is emerging as a best practice, and instead of looking at the credit score and or the debt-to-income ratio, it generally approves customers just based on their utility bill payment history, and the utility may set up its own internal algorithm for where they cut off approval versus rejections. Finally, hybrid underwriting is a combination of alternative underwriting and traditional or expanded underwriting. There are a number of concerns that utilities may raise when approached about on-bill financing. The most common response is, we don't want to be a bank. They're not comfortable with that business model. They would have to learn a lot of new best practices. They're concerned about default risk, administration costs, the need for new full-time employees to run the program, potential rate impacts, where they're going to get capital, and potential customer dissatisfaction. But all of these concerns are solvable by just looking at existing programs that have proven to be highly successful. Specifically, default rates has been a big concern for utilities, and fortunately, the experience of utilities that have run on-bill financing programs shows that the rates are very, very low. And there's actually no clear association with the underwriting methodology. So the alternative underwriting, while able to open up the program to more customers, actually doesn't seem to increase the default rate. Here's some high-level statistics in that area. And all of this will be available and recorded afterward. So here are a few examples of on-bill financing programs in the Southeast, and this is just a handful. There are additional programs at Alabama Power, at the city of Tallahassee, and Roanoke Electric Cooperative. And as you can see, by far the biggest in terms of the amount financed and the number of participants has been run by TVA. So here's a case study on TVA's program. So as a little background, TVA is the power provider for cooperative and municipal utilities in 7 states, including nearly all of Tennessee and parts of Alabama, Georgia, Kentucky, Mississippi, North Carolina, and Virginia, serving 155 local power companies altogether. The program was launched in 1978 and to date has achieved a market penetration a little over 2%. They do use private lender capital, and in 2012 they loaned out 6,173 loans totaling $44.5 million. Traditionally, over the lifetime of the program, 95% of the loans have gone for heat pumps, so a single measure. The other 5% have gone for more comprehensive weatherization projects. The average default rate has been 3%, which is rather low, even though it's on the high side for on-bill financing programs nationwide. And they do price in the default coverage into their interest rate of 6%. The program is continuing on with TVA's new eScore program. TVA is also going to be rolling out an off-bill financing option that will serve for some other uses, but the on-bill is still looking to be the more attractive from what I've been able to tell. For underwriting, it is expanded. They require a credit score of 625 FICO, and they've had a 75% approval rate. Now, the program is not going to be able to reach credit challenge or many lower income folks. Another program in the Southeast has been run by the city of Tallahassee's electric department, and it is offered to residential and commercial customers. It started off in 1983 with a coupon repayment system and moved to full on-bill financing in 1984. They're currently offering 5% interest rates plus a 1% processing fee, and they allow loans of $500 to $10,000 over 5 years for energy efficiency, and then up to $20,000 for solar installations and for certain retrofits of historic homes. Now, this program does require a property lien, so no renters are going to be able to participate. And property lien, in some cases, as PACE, property assessed clean energy loans, have emerged, have presented some issues with who gets paid first in the event of a foreclosure. And my understanding with Tallahassee is that they generally do subordinate to mortgage collectors, so that hasn't been an issue for them, and it's been running for quite a while. Uh, they annually give out 600 loans totaling about $3.8 million. They utilize alternative underwriting with their own proprietary system for approval based on billing payment history. Their default rate has been under 1%. Investor-owned utilities are a little bit different from, say, a power provider like TVA or a municipal utility or cooperatives, which Rory will get into in more detail. And they have a few different options for sources of capital. May come from ratepayer funds or shareholder funds or private lenders. Uh, if it's coming out of shareholder funds, the loans can earn an additional return for shareholders, which can give a profit incentive and may be attractive for utilities to consider. It can also be used to meet state energy savings targets very cost effectively. Now, any on-bill financing program, just like their entire portfolio of energy efficiency programs, would be subject to commission review for cost recovery and prudence. And here's a handful of the states that are currently running programs, on-bill financing programs for their investor-owned utility customers. So finally, here's a case study of an investor-owned utility that's been running on-bill financing for quite a while. Alliant Energy has a few variants in its service territories in Minnesota, Wisconsin, and Iowa. First, its shared savings program is a commercial and industrial program. It's actually, in Wisconsin, it ran from 1987 to 2013 and was actually the largest commercial and industrial on-bill financing program in the US, which is why I wanted to highlight it, and also to highlight some of the lessons learned in the more recent years of the program that led to it ultimately ending. It's still running in Minnesota successfully, and in Wisconsin, the utility decided in 2008 to make a couple of changes, and they led to a drop in program enrollment. One of those changes removed the ability of customers to receive rebates for certain energy efficiency measures if they were receiving financing. And the other requirement increased the loan seniority in effect and required all other lenders to that commercial entity to essentially sign on to this agreement that they will get paid after the utility gets its money back from on-bill financing. So they kind of went the opposite direction as Tallahassee in terms of seniority. During the course of its history, the Wisconsin program had 4,140 participants, loaned out $524 million, and its default rate was 2.68%. So that change in 2008 to increase seniority seemingly was pretty unwarranted given the low default rate, and I would encourage utilities in the future to avoid including a provision like that. They did use shareholder funds, and rather than charging an interest rate, they charged administration fees that were based on the types of measures installed. Certain measures had a 0% fee, or essentially free financing, because the utility wanted to encourage those measures. They did require bill neutrality in the sense that a 5-year payback period was required, or else the commercial entity would have to buy down the excess amount to close it out. They also offer residential low-interest financing in Iowa and Minnesota, and that program's also extended to commercial customers in Iowa. They use a private lender, and they offer loans ranging from $1,500 to $25,000. And they are able to combine with rebates that are offered. And the one exception is their new construction rebate program. The terms are flexible, ranging from 0 to 60 months. There's a 0% interest 1-year introductory rate with no fees, no security lien required. And then after that first year, there's a fixed rate of ranging from 0 to 6.9%, depending on the length of the loan term that the customer chooses. So I'm going to get ready and turn it over to Rory, who's going to give us more of a deep dive into cooperative programs. But first, I want to let everyone know that for further information, there is an entire page of DOE's C Action initiative that's dedicated to reports on on-bill financing programs. I drew a lot of the statistics I told you today from this site, and as I mentioned before, our slides will be available via SACE's website if you want to get back to this hyperlink. So Aaron, if you want to turn it over to Rory.
Okay. How we looking? Oh, whoop, that wasn't supposed to happen. How about we start from this slide? Here we go. Okay.
Looks good.
Am I coming through all right?
You are.
All right. Thank you, Taylor. That was a lot of great information. There's a lot of nuances to these programs and options for program designers and utilities who are putting these together. So that was a great overview. And I want to thank Southern Alliance for Clean Energy and Taylor for inviting me to present today. I will be focusing primarily on electric cooperatives. And just before the presentation, just to kind of provide a sense of the importance of focusing on electric cooperatives and the potential for developing programs that deliver significant energy and cost savings for members of electric cooperatives. There are over 900 total electric cooperatives in the United States, and they serve over 18 million total members as business, industrial, and residential, but 88% of those are residential members of co-ops. And overall, co-ops serve 13% of the total U.S. customer base across all sectors. So it's a significant portion of the number of people receiving electric service in the United States, and therefore the amount of demand. And co-ops also serve more rural customers than any other utility type when you look at also investor-owned and municipal utilities. And that means that they have the fewest customers per mile, which can increase the cost of delivering that electricity to their members. So that kind of illustrates the importance of electric cooperative energy efficiency investments. And as was mentioned before, through our program, we are focused on promoting and facilitating the development of on-bill finance programs through rural electric cooperatives in western North Carolina and eastern Tennessee. And we're focusing on both programs developed through individual cooperatives, but also on statewide efforts. And I'll get into a little bit more detail about that. But over the last year and a half of our program, we've made significant progress, and I want to highlight that one of the primary reasons that we've gotten to where we are today is because of the partnerships that we've developed with SACE and a number of other groups throughout the Appalachian and Southeast region, because that helps bring a lot of tools and resources and expertise to the table when talking about how to design these programs and how to make them happen, how to facilitate their implementation. So I think we kind of all understand what the benefits of energy efficiency and on-bill finance are, but for our part, we are focusing on, or the reason that we're promoting these programs is mainly because in the area that we are targeting in Appalachia, there's a high incidence of poverty, and there's a need for not only local economic development, but healthier homes. And the on-bill financing programs can help a lot of those folks who need help to improve their home's energy efficiency don't have the capital or access to capital to cover those costs. So the on-bill financing, especially the tariff-based program, opens up that accessibility. And I have a few slides that illustrate that need, not only in Appalachia but the Southeast. This map is something we created as part of our Google Maps gallery, which you can find online by searching Appalachian Voices Google Maps gallery. And the Google map is actually interactive. You can click on any electric service territory on this map. They're all outlined in gray, and you'll get specific information on the weighted average poverty rate for each of those service territories. And then we have two more maps. One that shows the percent of a household income spent on electricity bills, and then another one that has a map of rural electric cooperatives, which I'll show you. But the point of this map here is that basically anything that's in the medium orange to dark red is at or above the national average poverty rate. And so this illustrates the level of need from a poverty perspective in the region for alleviating poverty through reducing energy costs. And to show a comparison of how electricity costs present a burden for households in terms of how much they spend only on electricity relative to their income. This is the what we call the percent burden for customers of investor-owned utilities. And I'm going to flip back and forth a little bit, and you can see that, by the way, the national average was around 2.8%, according to the Energy Information Administration. And so you can see that for investor-owned utilities, and there's a lot of factors that go into this, where the heating comes from, whether it's electricity or gas. So this is just kind of a first approximation, but regardless, you can see when you flip between areas served by electric cooperatives and areas served by investor-owned utilities, you can see that obviously electric cooperatives serve folks who spend a greater portion of their income on electricity costs. And if we had done the same thing for poverty, you would see pretty much more or less the same differentiation between the two types of utilities. So that illustrates the need. But what this map shows is that even given that high level of need, there are very few comprehensive energy efficiency loan programs out there. And by comprehensive, I mean programs that cover the cost of multiple retrofits and improvements in a home. So that's why Tennessee is in green, because TVA's programs are compartmentalized, they're single item. But you can see that there are a number of programs in the Southeast. In the United States as a whole, there's over 30. And I believe that the Southeast has a little over, somewhere between 10 and 15 total programs, but I'd have to confirm that. And as Taylor mentioned, rural utilities, including electric cooperatives and municipal utilities that serve an area with a population of less than 20,000, can access USDA funding through a few different programs. The most notable and most available over the past year has been the Energy Efficiency and Conservation Loan Program. That is provided through the Rural Utilities Service. It is a loan guarantee program. It does provide an upfront chunk of money to the utility to cover administrative costs and get the program going. And then after, and I believe that's about a 5% upfront payment. And then after that, they pay the utility back on a reimbursement basis. And so that's an effective program. It is targeted more directly toward energy efficiency and conservation programs. And it also is currently capped at a total loan volume of $250 million a year, but that is sort of just a nominal cap. And in reality, if there was greater demand for loans through that program, they would then compete for the full $6 billion of loan funding available through the Rural Utility Service. But then there's another program that's been used to fund on-bill programs, and that's the Rural Economic Development Loan and Grant Program. That's actually what the South Carolina electric cooperatives used to fund their Help My House program, which I'll get into. And it's 0% interest loans or grants. The difference there is that there's a lower cap on the amount of available funding each year, and also the utility would have to partner with or develop a for-profit subsidiary business, and that business would have to be the one to apply for those funds. So it's a program directed at businesses and not nonprofit utilities, but there are ways around that. Excuse me. And then there's also a grant program called the Rural Community Development Initiative, which is available for electric cooperatives and municipal utilities to cover other program soft costs, such as marketing and workforce training and contractor certification and marketing and outreach. And so that's supplemental funds that are available. And finally, the Rural Energy Savings Program is a program that was passed as a provision in the Farm Bill last year or earlier this year. It has not been funded, but if a credit subsidy is approved through congressional appropriations, then that program will go into the rulemaking process through USDA and eventually could provide $75 million of zero interest loans per year to rural utilities, specifically for funding on-bill financing programs. And I've developed a summary of each of these programs. For anybody interested, I can share that with you. So there's a couple great models in Appalachian and the Southeast of tariff-based on-bill programs. One is the HouseSmart Kentucky program that covers Eastern Kentucky. It was developed through a partnership with the Mountain Association for Community Economic Development, which is a regional community development financial institution, and Eastern Kentucky Power Cooperative, which has 16 member electric cooperatives in Eastern Kentucky. And that was, I believe, started back in 2009 or 2010 as a pilot program. It's based on the pay-as-you-save model, which is the tariff-based model that is basically the go-to model for tariff-based on-bill programs that's out there right now. The loans are the service. It's marketed as a service and not a loan, and so it's tied to the meter because it's a tariff-based property service that's on the property, and it's transferable. So if somebody moves out, then the fees that are charged each month on the electric bill are just continue to be paid by the next tenant or owner of the property. And in terms of how the funding and financing works, it's I don't want to get into too many details about that, but basically the cooperatives recover the charges on the utility bill. There were 4 participant cooperatives in the pilot, and now that as they're scaling up, that's grown to 5, and they expect more. They have a network of certified contractors, and they initially got funding from the Ford Foundation at a 1% interest to start the program up and cover the first round of loans, and I say that with quotations. Each loan has a 5% markup. 4% of that goes to the 4 percentage points goes to their risk mitigation fund, which is what they call their loan loss reserve to cover defaults, and 1% goes to the co-ops to help cover their administrative costs. And each co-op also gets a payment from the Eastern Kentucky Power Cooperative for delivering those savings, and they charge 3% interest on the loan to the customer. And that's been a very effective program so far. They've the most recent report I saw is that they'd served over 160 homes. That's grown substantially since, I believe, late 2012 when they were reporting just around 100. And so they're picking up the pace pretty rapidly on that. And they've had a 57% conversion rate. So of the customers that received an energy audit, nearly 60% of those have moved forward on receiving the OnBill service. Over $1 million has been invested in the program, and we'll see that grow pretty rapidly from here on out. They put a 15-year payback period on each term, so the retrofits have to pay for themselves over a 15-year period at most. They've invested an average of $8,000 into each participating home, and they not only require that the program be bill neutral, but that the costs are actually capped at 90% of the estimated savings on an annual basis, which helps ensure that the electricity bills are actually reduced. Now I'm going to kind of pick it up a little bit just in the interest of time. But as you see here, it's been an effective program, achieving an average of 21% savings per home, which is a significant amount of money on an annual and multi-year basis, but also a significant amount of energy that's saved. And the South Carolina Help My House program is actually a consumer loan-based program that they passed state legislation to do certain things that sort of made it into a tariff-based program in a sense. And what I mean by that is that they tied the loans to the meter. They allowed them to be transferable, and they also capped the savings, I believe, at somewhere around 80%, or capped the cost at 80% of the savings. And so because it's transferable and in relation to that tied to the meter, it operates similar to a tariff-based program. They did have to get consumer lender protection exemption for the participating cooperatives, and they are offering that model to all cooperatives. But if any of the cooperatives try to increase the interest rate above 4%, then they aren't protected under that state legislation. So the state legislation capped the interest rate as well. And just real brief on the impacts of that program, they targeted the worst homes. So they targeted homes that had an average consumption of over 30,000 kilowatt hours per home per year. And so these impacts are a lot higher than you'd see anywhere else, and a lot higher than you would see in a larger scale program. But they were significant, and it kind of gives a sense of how these programs, what kind of impact these programs can have for the homes that need them the absolute most. And so they saw annual savings of around $1,150. And because they cap the savings, those folks get to pocket nearly $300 each year. And after the loan has been paid off, their annual savings are estimated at $1,100. And the Environmental and Energy Study Institute, which is based in Washington, D.C., and they were part of this program, developing this program, they have a report of all the impacts from the Help My House program, and you can find that on their website. And let's see, I want to kind of highlight the most important things, so I'll run through these, but there was a big announcement recently from the USDA that Roanoke Electric in eastern North Carolina had received the first EE CLP loan to fund an OnBill Financing energy efficiency finance program. And that's a pretty substantial news because it shows that model is now an approved model by USDA for these types of programs, and for them to get approved for an EE-CLP loan. And they're just overall, in terms of the goals of these types of programs, it provides a good model for how OnBill financing programs can be structured in order to ensure savings and increase accessibility for all of their members. And so you can see some details on that. North Arkansas Electric Cooperative was another recipient, but they focused on a broader set of improvements. So let's see. And finally, in Tennessee, we've seen a lot of great things happening, a lot of momentum toward potentially or possibly developing a statewide on-bill program for electric cooperatives. It came together through partnerships and because of the fact that there are leaders of electric cooperatives in Tennessee and the state association that truly believe in helping their members, and so they're exploring OnBill financing as a potential option for helping reduce energy costs for their members. And I'll leave that for more questions here in a minute. But over the last year, basically, we've seen, and even the last 8 months, we've seen a lot of movement by the State Cooperative Association and the State Energy Office and Appalachian Electric as one of the primary leaders toward exploring how they can make this happen and what the program might need to look like, not only to protect their participating cooperatives, but also to benefit the members of those cooperatives. And at the moment, there's a lot of discussion happening about program design. And I'm going to go ahead and move on to the next slide. What has been discussed primarily is that it would be a tariff-based program. They would tie it to the meter. They're still considering whether or not to require that the program be bill neutral. Alternative underwriting is, as Taylor described, where bill payment is used in lieu of a credit check. And they've been discussing whether or not to include rental properties. They do want it to focus on low-income members primarily, but not exclusively. And they're looking at the EE CLP as a possible source of funding. And one thing that has been discussed but definitely has not been committed to, it was just thrown out there as an idea, I would say at the most, is that the Tennessee Valley Authority, because they have their own energy efficiency targets, may be exploring paying for each kilowatt hour of energy savings delivered through the statewide program. And so that's really exciting, something that we pushed for or promoted to the state association and many of Eastern Tennessee's cooperatives, and have been really happy to partner with SACE and others to try to help make that happen. And I'm going to leave it there for now. Maybe we can leave. There's a couple of slides on the potential impacts of what an EE CLP funded statewide co-op on-bill financing program could be, and also I wanted to get into some of the challenges, but we are nearing the end of our time, so I think I will just leave it open for questions.
Thanks, Rory. That was a great overview of what's going on the cooperative side. We do have quite a few questions here, and I'm definitely happy to follow up offline. As you can see, we've listed contact information for both Rory and myself on this last slide. Quite a few of our questions here are asking about how to get the presentation, and I'll let Aaron explain that at the very end after Q&A. I have a question here about studies for assessing on-bill financing programs. I would definitely first refer you to that See Action page that I had on my last slide. They have a number of reports that give case studies of on-bill financing, high-level statistics, a analysis of the different program design options, and there's also an ACEEE report that I did not link to in the slides, but if you have a hard time finding it, feel free to email me and I can send you a link. I believe it came out in 2011, so it's a little bit out of date, but it was a very good analysis. I have a question here: what level of savings is achievable? I think Rory might have gotten into that a little bit, and I did to some lesser extent. Yeah, so in the South Carolina program, for example, they're achieving on average 34% savings at the individual homes that participated. So on the project level, the savings is extremely high. And then you just factor in what participation level you can get, or market penetration, in other words. And, I think we were modeling potentially up to 20% for some programs. But on the other hand, I will point out that the TVA program, for example, which for many years was basically just heat pumps, achieved about a 2% penetration over its 7-state service territory. I've got another question here referring to the TVA example, asking if it was private loan capital from a single lender or multiple. It was a single lender. It's a regional bank. I don't know if the name of that bank has been disclosed offhand, but you could certainly ping somebody at TVA about that, and if you want to follow up, feel free to email me and I can point you in the right direction. I have a question about the default rate in the Iowa and Minnesota Alliant Energy examples. That it's asking, was that rate only applicable to non-low income customers? So not specifically, but it had, my understanding is it is pretty traditional underwriting, so a lot of lower income customers would likely not qualify. And the question goes on to ask, are there any examples for default rates for programs that are open to low income? I would point again to the South Carolina program, which has a shorter history and lower data set to glean from, but it's a really great example of something that's worked really well for low income, and so far there have been 0 defaults. So as low as 0%.
Taylor, I can add about Maysed's program is also, again, it's at the same kind of level. It doesn't have a very long history, a lot of data, but I'm pretty sure, I think they're at a less than a 1% default rate for the Housekeeping Kentucky program as well.
That's great. I've got another question for Rory here. Can you clarify the existing TVA on-bill financing and the difference between what's being discussed for the statewide Tennessee program?
Yeah, so, and I think Taylor alluded to this or talked about this some, but TVA's program is, first of all, it's run through it's financed by a private lender. So when you talk about the semantics of labeling these programs, that's really more of an on-bill repayment type program. On-bill financing is mainly utility and shareholder or public funds. And the other thing is that, first of all, it has a higher interest rate than most on-bill financing programs out there. The 6% on the heat pump program is higher than we're seeing for the Mayset Housekeeping Kentucky program, the Roanoke Electric program, and the South Carolina program. And of course, South Carolina started with a smaller interest rate on purpose in order to minimize the costs for the customers. But the other thing is on-bill financing programs they generally aim to finance a comprehensive set of retrofits all through the same service charge, whereas TVA's programs are compartmentalized, and it's a lot harder to combine the weatherization assistance with the heat pump assistance. And finally, TVA's programs do look at credit scores, and they have a minimum FICO requirement of 640. I think they're going to reduce that, but I believe it's been 640, and that has cut out a lot of folks from being able to access that financing. So those are the primary differences.
Awesome, thanks, Rory. I think we've got one more question here that's also directed to you. From an organizing perspective, who would be the typical / best partners that could persuade co-ops to consider an EE CLP application?
Well, I mean, I think the electric cooperatives, and I've seen this a lot more in Tennessee, the electric cooperatives, they understand the needs of their members. They also understand their cooperative and what financial situation they're in, what challenges they'll be facing. Um, and so, and like I said earlier, we've been fortunate that there are what we call leaders in Tennessee. Greg Williams at Appalachian Electric was immediately interested in starting to have this conversation. David Callis at the State Cooperative Association, and then the State Energy Office, Luke and Molly Cripps up there. And so they've shown a lot of great leadership. But on the individual cooperative level, you may have some cooperatives that are more financially strapped and have a lot less capacity. So, and I'm saying all this because it's not really that you need to criticize or pressure the cooperatives from an organizing standpoint, but from an organizing standpoint, you can educate the members and also identify the level of need among the membership and portray that information to the cooperative and generate demand from the members for programs that support more of those members to reduce their energy costs. And so that's kind of a long-winded response. But community-based organizations are really important. Local Rotary clubs, hospitality houses, habitat offices. I mean, there's a lot of organizations on the community level that already provide some assistance to folks either to live more comfortably and have their home be healthier, but also to reduce energy costs. And those groups have a longer standing history of being connected to those communities, and so that's always a good resource, at least to be able to set up presentations or reach out to those members directly to identify what their needs are and to talk to them about energy efficiency and OnBill financing.
Great, thanks, Rory. I think we'll go ahead and turn it over to Erin. I don't see any other questions coming in, and she can give you the details on how to access this recorded webinar and the slides.
Great. Thanks, Taylor. Thanks again, everybody, for joining us today, and to Taylor and Rory. That was a really interesting webinar. I hope everybody enjoyed it. For more information, please check out our website, cleanenergy.org. We have been recording the presentation, as Taylor mentioned, and it will be available on the webinar archive page of our website, cleanenergy.org, and you will receive a link to that recording once it has been processed, and most likely will be the beginning of the week next week. So keep your eye out for that. And we can also include, Taylor, we can also include the links that you have been referencing throughout the webinar too. So that'll be a little easier for folks. We appreciate everybody's support and interest and hope that you'll join us again. Thanks, guys.
Thank you.